Accounts receivable line of credit financing, receivable financing with credit lines for businesses. Call 888-653-0124 today or click the link in the description to learn more. How much cash flow does your company generate from its sales? If you don't have enough, then you might want to consider accounts receivable line of credit financing. This type of financing allows you to borrow against future accounts receivables. Most businesses rely on credit to finance their operations. The problem is that they often run out of cash before they get paid back. That's where accounts receivable line of credit financing comes into play. A line of credit financing program is a great alternative to traditional bank loans. Many businesses are turning to accounts receivable lines of credit to finance their growth. An accounts receivable line of credit is a revolving loan used by companies to fund their cash flow needs. They can borrow up to 100% of their current accounts receivable balance. Accounts receivable lines of credit offer several advantages over other forms of financing such as term loans and commercial paper. Business owners and business growth. If you're just getting started, you may not be familiar with accounts receivable (AR) financing. But this type of financing is available to small businesses, including restaurants, bars, retail stores, and others who need cash quickly. With AR financing, you borrow money against your accounts receivable. This means that when you collect payments from your customers, you pay back the loan. The loan amount is based on the value of your accounts receivable. When you use AR financing, you can usually get a better interest rate than you would get from a bank loan. And because you're borrowing against your accounts receivable, you don't have to worry about collateral. But there are some things to consider before applying for AR financing. First, you must have enough cash flow to cover the loan repayment. Second, you should only apply for AR financing if you have a solid relationship with your suppliers. Otherwise, you could end up paying more than you borrowed. Taking advantage of business opportunities. Unpaid invoices and seasonal demand create opportunities for business owners to take advantage of accounts receivable line of credit. For example, during the summer months, many people go on vacation or travel. In addition, many retailers increase their prices in order to make up for lost profits during slow periods. These events can put a strain on a business's cash flow. Many businesses turn to this form of business financing to help them with additional cash flow. The best time to apply for receivable loans is when your business has a good relationship with your supplier base. You'll also benefit from lower rates. Receivables Factoring. Factoring is a great way to finance your accounts receivable. It allows you to pay your clients faster than waiting for them to collect payment from their own bank account. Here's how factoring works. Your client pays us a small fee up front to cover our costs. We then use this money to purchase your invoices from you at a discount. This means we're able to pay your clients quickly, saving you time and money. And because we're buying your invoices at a discount, you receive cash right away. So you can spend this money on whatever you need to grow your business. Handling receivable balances. If you're not familiar with accounts receivable (AR) financing, it's basically a line of credit that allows businesses to pay off their outstanding invoices over time. The AR line of credit is usually set at 90 days, meaning that a company can borrow up to 90 days worth of its outstanding invoices. When a business uses this type of financing, it typically pays back the loan over several months. This means that the business doesn't need to sell any additional inventory to repay the loan. Instead, it simply collects money owed to it from its customers. This type of financing is perfect for small businesses that don't have enough cash flow to cover their monthly expenses. It's also great for companies that offer services that take longer than 30 days to complete, such as landscaping projects. To qualify for an AR line of credit, a business must be able to prove that it has sufficient cash flow to pay back the loan. Typically, this means having a positive balance in its bank account every month. Companies that use this type of financing often receive interest payments based on the amount of their outstanding invoices. So, when a company receives a payment from a customer, it records the payment as an asset on its books. Then, when the invoice is paid, the company credits the payment against the outstanding balance. Once the invoice is paid, it becomes part of the company's accounts receivable. In turn, the company can apply the payment toward future invoices. As long as the company keeps paying down its AR line of credit, it can continue receiving interest payments. And since it never needs to sell additional inventory to pay off the loan, it can keep collecting money from its customers. Asset-based lending and asset-based lender control. An asset-based lender control loan is a type of revolving line of credit used by businesses to finance working capital needs. Asset-based lending loans are typically offered by banks and other financial institutions who specialize in providing these types of financing. Asset-based borrowing helps small businesses grow by allowing them to borrow money against their current assets. This means that instead of borrowing money from a bank, a company can use its existing cash flow to pay off the loan. These loans are attractive to the asset-based borrower because they offer flexibility and convenience. They're often available when needed, and there's no need to wait until the end of the month to apply. Asset-based financing loans are also attractive because they allow companies to access funds quickly. Since these loans are based on a company's current assets, they can be approved within minutes. Asset-based lenders provide loans which are especially useful for growing businesses that may not qualify for traditional bank loans. ABC lenders understand that many small businesses cannot obtain bank financing due to lack of collateral. They are ideal for businesses that require short-term working capital. Lenders usually require at least 2 years of positive operating history and a minimum net worth of $250,000. Asset-based financing basics are beneficial for businesses that generate revenue through sales rather than services. These lenders prefer businesses that sell products or provide services directly to consumers. ABC loans are most commonly used by manufacturers, distributors, wholesalers, retailers, service providers, and other businesses that sell goods or services to customers. ABC loans are similar to factoring, except that ABC lenders don't charge interest on the amount financed. Instead, ABC lenders collect monthly payments equal to the outstanding balance of the loan plus any fees associated with the loan. A receivable company typically charge between 2% and 5% per year for this type of financing. The rate depends on the type of loan and the borrower's credit rating. Receivable financing agreements are typically secured by the borrower's accounts receivable. However, some ABC lenders do offer unsecured loans. Asset-based lines are generally available for terms ranging from 1 to 5 years. Some lenders offer longer-term options, but the typical term is 3 years. Payment purchase discounts. Discounts are great for boosting sales. They're especially effective when combined with payment plans. When you offer discounts, you give your customers a reason to purchase now rather than later. And because you're offering them a discount, they're more likely to pay off the entire amount at once. But there's another benefit to offering discounts. Customers who receive discounts feel better about buying from you. They trust you more and are more likely to return to your store. That's why it's important to offer payment plan options. Payment plans allow your customers to spread out payments over several months or years. This gives them the flexibility to pay for items over time. And since you're offering payment plans, you can use this opportunity to offer special discounts. For example, you could offer a 10% discount to customers who sign up for a payment plan. Or you could offer a 5% discount to customers who pay off their purchases within 30 days. Cash flow gains versus predictable cash flow. Cash flow is the lifeblood of any business. Without cash flow, there would be no business. When you're running a small business, it's important to keep track of your cash flow. This way, you can predict when you'll need to pay bills, purchase inventory, or hire employees. If you don't know where your money comes from and goes, you won't be able to plan ahead. So, you need to understand your accounts receivable line of credit financing. An accounts receivable line of credit is a type of loan that allows businesses to borrow against future sales. The receivable factoring is typically used to finance payroll expenses, equipment purchases, and other short-term needs. With invoices in exchange for financing, you can take advantage of interest rates that are lower than those available through traditional bank loans. And because the loan is secured by your company's accounts receivable, you can use the funds to cover unexpected expenses, rather than having to dip into your own personal savings because of your cash flow dilemma. Call 888-653-0124 today or click the link in the description to learn more.